So this is going to be a risk management course for you, Forex traders. If you're experienced trader, this will help you a lot too. So I'm careful and I've been ranked top 3 in multiple international trading contests as well as number 1 in a Singapore trading contest. Currently an equity analyst, also an author and international speaker. And I graduated with a finance degree from Singapore. What you learn by the end of this course, make sure you take down your notes in your notebook with pen and paper. Why risk management is more important than your trading strategy. Key principles you need to understand. Risk per trade, very important. Position sizing, this is the one you need to pay attention to. Risk to reward ratio, this is the secret of professional traders. Stop loss orders, how to set them. Take profit orders, how to set them too. Leverage, what kind of leverage should you use? What is it? Drawdown, how to manage your risk with risk management tools, common mistakes in risk management, as well as risk management secrets of institutional traders and hedge fund managers and professional traders. Okay, so why is risk management more important than your trading strategy? Because if you talk to any professional traders, read all the books, they will always say that the key to success is risk management. Now, for beginner traders, I know this is hard to digest because you might think trading strategy is the most important. Once you become experienced, you understand what I'm talking about. The best traders in the world, the one that I've talked to in hedge fund events where I've spoken at, the ones where I interviewed them, the books that I've read, they are super good in risk management. They might not have the best trading strategy, but they are super good risk managers. So they are risk managers first, traders second. Because when you take care of the risk, the profits will take care of itself. But if you focus on the profits, the losses will not take care of themselves. Helps you preserve capital, reduce emotional trading, and ensure long term profitability. You can have a good trading strategy with a high win rate. Okay, now this is what a lot of retail traders like to focus on. High win rate. You see it on social media, a lot of people are preaching high win rate. I can tell it's not that important. Okay, you can have a good strategy with high win rate, 99% win rate, and you can still lose money at the end of the day if your risk management is not good enough. Okay, so some of the key principles of risk management you need to know, even for investors. Okay, the number one rule is to protect your trading account from significant losses. Capital preservation first, then profits second. Lots of retail traders have this upside down. They focus on profits first, then capital preservation. They don't even care about that. Okay. Even Warren Buffett says, rule number one, don't lose money. Rule number two, remember rule number one. Okay. Risk to reward ratio. Always aim for a positive risk to reward ratio. Your reward has to be more than your risk. So let's say this is your entry price and you set your target price at, let's say, 100 pips. You cannot be risking 200 pips, 300 pips. You gotta be risking less than what you are taking in terms of profits. Now, because of trading psychology, a lot of times this would become upside down. A lot of people will take profit too fast, then cut their losses too late. Avoid over leveraging, control your use of leverage to prevent excessive risk exposure. Again, if you study the top traders all around the world, okay, they found out that those traders in Hong Kong, there's a group of them that are very profitable because they found out that they use low leverage instead of high leverage. 1 is to 50 is already very high. You can become profitable just from using 1 is to 20, 1 is to 10. Okay, a lot of times I use 1 is to 20, but also depends on your risk appetite. Some of the risks you need to take note of before you start trading Forex. Okay, the first one is market risk. This is basically the risk of losing money because of unfavorable price movements in that currency pair. And then credit risk. So certain countries they would have poor credit ratings, and this would cause the currency to be very unstable. So what you need to do is to avoid countries with bad credit ratings. So to be safe, just trade the major pairs because those currencies would have good credit ratings. Next one, leverage risk. Don't use too high of a leverage. Interest rate risk. So that's why as a trader, you gotta monitor interest rates and country risk. So when there's an economic or political instability in that country, let's say the political situation is not that stable, then it's going to cause the currency to become very chaotic. Okay, so when you pick a currency, make sure that the political situation is stable. Again, pick the major pairs to be safe. Counterparty risk, basically, when you trade, you need a broker. And if you pick a bad broker, then the broker will default. And then when you want to withdraw your money, you won't be able to do that. So make sure you pick a good and right broker. Next thing, liquidity risk. When you trade during non-active market sessions or non-active sessions, okay, let's say the Asian trading session, which is the most quiet trading session, when there's low liquidity, sometimes it's going to be hard to execute a trade. And hence, because of the low liquidity, then you'll be very prone to slippages. So to be safe, trade the liquid sessions, which would include the London session as well as New York session. Basically, a lot of traders they trade the London, New York overlap because it's the most liquid trading session of the day. And then gap risk. So if you hold your trade over the weekend, let's say market closes over here on Friday night, and if there's a significant event that occurred over the weekend, the price is going to gap downwards. Let's say if you put your stop loss here, and then the price is going to open right here, and it's not going to trigger your stop loss. So that's what you'll be exposed to when you hold your trades over the weekend. So if you do that, make sure you check is there any significant event coming up in the weekend to decide whether you should hold your trade past the weekend. And some hidden risks that a lot of people might not talk about, psychological risk, make sure that your trading psychology is very strong. You have diversifiable risks. Later I'll share with you how you can diversify away your risks. Okay. The good thing is that it can be controlled and managed. And trading frequency, now a lot of beginner traders, they think that they have this misconception that the more trades they make, then the more profitable they'll become. Whereas for professional traders, they realize that, you know what, it's all about making that one good trade. In fact, there's a book that's called One Good Trade. It's all about making the highest quality trades possible. So a lot of times you'll find that professional traders they would make like one trade in 2 weeks. They just make one trade. And that one trade is more profitable as compared to the beginner trader who in one day scalp or day trade and open 10 trades. Okay? It's not about the amount of trades, it's about the quality of trades. And the more you trade, the more likely it is that you lose money. So to decrease your stress, improve your productivity, improve your profitability, decrease the amount of trades you make. Only take the high quality ones. So what is most important in risk management? Okay, so a lot of people have the debate. What is more important? Leverage, margin, win rate. I would say number 3, it's percentage win rate. I've seen traders, okay, with like 95% win rate. Last time, I myself in my first year, 90% win rate, okay? 50 straight wins. You have all these like bragging rights. At one point in time, I had 50 consecutive wins. Looks good, right? Looks successful, right? But then, because of bad money management, bad risk to reward ratio, these people don't make any money. Okay? So the second most important thing is risk to reward ratio. Okay? You realize that the top hedge fund managers in the world, if you study them, they have a win rate of only like 40%, 50%. Okay? But they are the most profitable trader, hedge fund manager, billionaire investors, top investors in the world. Okay? They're the top in the world. Because their risk to reward is very, very good and their risk management is very, very good. Oftentimes you see them using 1:3, 1:4. Okay? So number one, I would say, is position sizing. You can have the best risk to reward ratio, best win rate, but then if your position sizing is all over the place, you're still not going to make money. The first thing you need to ask before you get into a trade is how much am I risking in this trade? Guess what a lot of beginner traders like to ask themselves? How much money can I make in this trade? You see the difference? If you study the top hedge fund manager like Paul Tudor Jones, before he opens a trade, he thinks about the downside. And then when he takes care of the downside, the profits will take care of themselves. Basically, you need to ask yourself, if this trade does not work out, can I afford to lose this amount of money? Always ask this question before you get into a trade. So let's get into the first concept of risk management, which is risk per trade. Okay, so this is the percentage of trading account you are willing to risk on any single trade. So the typical value would be 1 to 3%. Based on your risk appetite, you gotta decide on day one, should I risk 1% per trade, 2%, or 3%? The higher your risk appetite, the more you can risk. And if you're conservative, then you can start with 1%. Okay? And many traders risk 1 to 2% of the account balance per trade to limit potential losses. I've seen some professional traders, they risk 0.5% to 1%. And it's okay because they're trading super large account sizes, so they are earning a lot of money. And beginners, you can start with 1% per trade. So it also depends on your experience. If you're a beginner, start low. If you're more experienced, you can afford to risk a little bit more. Controlling risk per trade ensures that no single trade will significantly impact your account. Now, if you're a beginner, please don't make this mistake. Let's say if you open your MT4 and then you key in 0.1 lot size all the time. It doesn't mean that you're risking the same amount all the time. Because let's say if today on day one you're risking 20 pips and you key in 0.1, then tomorrow you're risking 30 pips and then you still key in 0.1. Then tomorrow you're risking, let's say, 10 pips only and you key in 0.1. So every day you're risking a different percentage. Risk per trade is different from the lot size. This is a mistake that a lot of beginners make. They think that the same lot size means that I'm risking the same amount all the time. No, it's wrong because the stop loss that you're risking is different. So don't open too many positions at once, but it depends on your account size too. And also, if you have a trading strategy that has a high win rate, you can also afford to take a larger percentage risk per trade. But just to keep things simple, determine the risk per trade based on your risk appetite. I would say 1% for conservative traders or beginner traders, 2% for moderate risk takers, and then 3% for risk takers as well as professional traders. Okay. So should you determine the risk per trade based on your experience or risk appetite? I would say risk appetite is more important. Okay. So don't care too much about whether you're a beginner or experienced trader. You gotta determine the risk per trade based on your risk appetite. Okay, so this is the formula. Risk per trade is equal to account size times risk percentage. So let's say you're a beginner trader and you want to risk 1% and you're starting off with a $10,000 account. So if you lose money on this trade, how much are you losing in monetary terms? So you take account size 10,000 times 1%, which would give you $100. So every time before you open a trade, you gotta know this number. How much money will I lose in the event that this trade doesn't work out? So here's why you should not risk too much, okay? I know it's sometimes very tempting to risk too much because you want to rush things, grow your account fast. The best investors, best traders in the world are patient, super patient. So the thing is, when you risk too much and then you get a winning trade, and then what's going to happen is that you're going to be overconfident, and hence the way you open your next trade will be very sloppy in terms of the risk management because you'll be like, I'm invincible. Let me just put in any lot size. Then if you risk too much and you get a losing trade, then it's going to end up really bad. You're going to revenge trade to recoup everything. You're going to break your trading plan, use a strategy that you've never used before, or just enter randomly, or it's just going to cause you to quit because you have lost so much. It's so hard to recover. So you can see that regardless of the outcome, risking too much, way beyond your, let's say, 3% requirement, is just not going to end up with a happy ending, you know? The thing about trading psychology is, why is it that you're so emotional when it comes to trading? To handle and control emotions in trading, the solution is to apply proper risk management in your trades. You realize that if you risk just the right amount that fits your trading personality, you would have very little emotions. Whereas if you one day wake up and you risk way beyond your own personal requirements, you'll be super emotional. So, in a way, risk management can be used to control your trading psychology. So, let's get into detail right now. So, when you key in 0.01 into your trading platform, you're trading one micro lot. Okay? When you key in zero point 0.1, you're trading one mini lot, and one would represent standard lot. Okay? So, nowadays, brokers allow you to trade various different kinds of values. So when you're trading 0.01, one micro lot, okay, you're trading 1000 units. Don't need to care too much about these units because most of the time you just need to key in volume. But some trading platforms would require you to key in units. Zero point 0.1, you'll be trading 10,000 units. One standard lot, you'll be trading 100,000 units. So when it comes to value per pip, later you need this to calculate your position size. When you're trading one micro lot, value per pip is 10 cents. When you're trading one mini lot, value per pip is $1. One standard lot, value per pip is $10. So most brokers would allow you to execute trades based on standard lots and mini lots. So if you have a $5,000 account, okay, you can trade with mini lots. Especially if you're a day trader who is making many small trades per day. But if you're a swing trader, you would make fewer trades, but your trades would have a larger size. So if you're a long-term trader, swing trader, then you'll need more capital, or you may need to trade smaller lot sizes. And the thing is, if you're a beginner trader, don't go straight into mini lots because for beginner traders, you gotta start with micro lots just to train yourself how to trade with real money. So I would say micro lots are for people who are just starting out, want to test out the feeling of trading with real money. Microlots is a great way to hone your skills and you can test out your trading method, trading strategy without risking too much capital. Okay, so what is a pip? Just now I talked about pip. Basically, it's the price movement in terms of percentage in points. Pip actually stands for percentage in points. It is the smallest movement in an exchange rate. So, for example, in euro dollar, one pip is 0.0001 of the price. So, you can see that trading platforms they would quote the prices in 4 to 5 decimal places depending on the currency, or sometimes 2 to 3 decimal places. So let's take euro dollar over here. You can see the ask price. Now it is supposed to be 4 decimal places just like this, but then a few years ago a lot of brokers they added an extra digit just to make things more specific. So there's an extra number right at the back. But typically we can just assume that it is quoted in 4 decimal places. So all the currencies you can see over here, they are listed in 4 decimal places. Whereas for yen currencies only, they are the only ones that are listed in 2 decimal places. It's 2 decimal places, but like I said, brokers have added an extra number at the back, so it becomes 3 decimal places. For yen currencies, 2 decimal places. For the rest of the currencies, it will be 4 decimal places. If you want to be more specific, you can look at the last number. So basically, this is the formula. Minimum movement, meaning is it 0.01 or 0.0001, 2 or 4 decimal places, times trade amount. So if you are trading one standard lot, it will be 100,000 units. And let's say if you are trading dollar yen, which is 2 decimal places, divided by current exchange rate. So let's take the ask price of dollar yen, 0.01 times 100,000 divided by 149.15. And you get an answer of USD around 6.7. If you are trading one standard lot, those currencies with USD as the quote currency, meaning the currency on the right side is USD, then the value per pip will be straightforward $10. Whereas if dollar is on the left side, meaning the base currency, then you need to calculate the value per pip. And you can see bid price over here, ask price over here. Basically, bid is the price at which the broker buys the currency pair from you, the customer, and ask is the price at which the broker sells the currency pair to you. So that's why you can see that ask price is always higher than the bid price. When you open a buy trade, you will open it at the ask price. When you open a sell trade, you will open it at the bid price. And the difference between bid and ask would be the spread, meaning the cost you need to pay to the broker. For Forex, normally there's no commissions. Doesn't mean that if there's no commission, then it's the best broker, because sometimes it's cheaper to pay a commission with a broker that has narrow spreads as compared to paying a broker that is commission free but has a wider spread. Right now, we are going to calculate the amount of money that you can potentially earn in your trade. Okay, so you can look at this formula over here. Profit equals to pips gain times pip value. So let's say you're trading standard lot, one standard lot, you're trading euro dollar, and you bought it at 1.1000, and then you took your profit at 1.1050. One standard lot is $10 per pip. So the price from your entry to your TP increased by 50 pips. Just take your TP minus the entry price, then you get 50 pips. So very simple. Pips gain, we gain 50 pips times value per pip $10, and you earn $500 from this trade. So why am I showing you this? Because even though trading platforms, after you close the trade, you can see a P&L, you can see a profit. But the problem is that you only can see your profit after you have entered the trade. So to manage risk effectively, you need to calculate the profit before you even enter the trade. So this is why I'm showing you this manual calculation. But nowadays, a lot of times there are online calculators that can do everything for you. So the very common position sizing mistakes that I see traders make, like I said just now, they set the number based on emotions and confidence levels. Never do that. Not calculating it properly, skipping it altogether because they felt that's too troublesome. This is something that you should not do, because most traders follow this sequence. They think about, okay, before they enter a trade, they think about how much money I want to make. How much money can I make? Then they determine their position size next, probably based on emotions or confidence levels. Only then they'll determine their stop loss. Now, this is wrong, wrong, wrong. Professional traders follow a different sequence. Professional traders think about how much money am I risking? Okay, in this trade, that's the first thing they ask themselves. Then they determine their stop loss. And from this stop loss value, then they can determine their position size. This is the sequence you should follow. Okay? And a lot of beginners also like to think that, oh, the wider my stop loss, then the riskier it is. It is not, because position size is inversely proportional to stop loss. So the wider your stop loss, okay, the lower should your position sizing be, so that your percentage risk per trade remains consistent. Okay? When you look at this formula, then you understand. Because position size is calculated by account size, meaning your capital. Risk percentage, like I said just now, do you want to risk 1%, 2%, or 3%? Later, I'll share with you different ways to set your stop loss. Let's take an example. Today, you're trading dollar yen at 149.20, and you want to set your stop at 148.80. So, how much pips are you risking over here? Do a quick calculation. There'll be 40 pips. And let's say you're risking 2%. Okay, so let's calculate the position size. So I'm going to use the pip value that we have gotten just now. Scenario just now, our account size is $10,000. We are risking 2%. Stop loss, 40 pips. Just now, our pip value for dollar yen is $6.70. Your position size would be 746, which is also equivalent to 7.46 mini lots. Okay, now let's go to leverage. Basically, it is also known as borrowed money. You're borrowing capital from your broker to increase your trading power, and it amplifies both profits and losses, which can lead to margin calls. Make sure you limit your leverage to 1 to 50 or lower to reduce risk exposure. So don't confuse leverage with position size, because leverage basically just affects how much capital you need to open a position, but it doesn't affect how you calculate your position size. It also doesn't affect the risk you take per trade. So if you're risking 2%, regardless of the leverage, you're still risking 2% per trade. Basically, high leverage just gives traders an illusion of security. It makes it seem like they're taking a small position, but they're actually exposing themselves to a lot of risk. To illustrate what I've mentioned just now, you can see over here I have 3 comparisons. Pro trader over here, let's say decide to use zero leverage, no leverage. And then you have another trader over here, okay, who is more conservative. Then he decides to have less leverage. Then you have a beginner trader over here, okay, and then she over leverage, okay. I would say 50 to 1 is a bit too high. Let's say 3 of them start with the same amount of capital, $1,000. But because of the different leverage, you can see the borrowed capital is different. Okay? The one with no leverage borrows zero money from the broker, 5 to 1, borrows 4,000 from the broker. The one with 50 to 1 leverage borrows 49,000. So after a 5 pip move, he earns 50 cents, but then when he loses 50 cents only. Okay? 5 to 1, $2.50, $25, 50 pip move, $5, $25, $250. This can be good for her, but then it can also be bad if she loses the trade. Okay? 500 pip move, $50, 250, 2050. You can see the big difference. So basically, a 5 to 1 leverage lets you control $5 for every $1 that you have. Whereas a 50 is to 1 leverage allows you to control 50 times of what you have. So before you think about leverage, how much money it can make you, also think about how much risk are you exposing yourself to. Especially if you open many different trades at one day, in one day, you would have accidentally maxed out your margin, your capital, and then get a margin call if you trade like this with many different open trades, especially when they are correlated to each other. That is even worse. Okay, right now let's talk about margin. And basically, what is margin? It refers to the amount of capital required to open and maintain a leverage position. The amount of money that's required for you to maintain an open position. And it acts as a security deposit. It's kind of like a collateral security deposit, which ensures you can cover potential losses on your trades. So if your account goes below the margin requirement, then the broker will not allow trades to be open until you deposit more money. And also, if you're somebody who like to open a lot of trades, then you might use up a lot of your margin very fast. So if you do that all the time, you're gonna monitor your available margin. Because if all your positions move against you at one time, then the broker will close some of your open positions. That's why you need to have a good level of cushion in your account. That's why sometimes when traders like to ask, can I start with $500? Yes, you can, but then like you can only open a very small trade, one or two small trades. Basically, to put in simple terms, the initial capital that you put into your account in order to open a trade is called margin. Okay? So basically, margin, the formula goes like this: position size divided by the leverage you use. So you need to understand that while a high leverage allow you to use less of your capital as margin, but it also means that the price movements will have a very significant impact on your account balance. So if the price doesn't go your way, then you're gonna lose a lot of money. Then if you use a leverage of 50 to 1, Then the formula goes like this. Then it will be 7460 divided by 50, which gives you a margin of 149.20. Then if it's 1:100 leverage that you're using, then you divide by 100. Then very simple. Then it will be 474.60. So as you can see, using a higher leverage will allow you to use less of your margin, but then it is less safe as compared to a lower leverage. So if you don't have enough margin, in other words, capital to start a proper trading account, you can opt for a funded trading account with this prop trading firm called Apex Trader Funding. So if you trade futures, then you can opt for all these different plans with various starting capitals. So you have all the way up to 250,000, 300,000, 100,000, 25,000, 50,000, 75,000. So basically, this prop trading firm allows you to trade various types of instruments, equity futures, currency futures as well. And so far with Apex, they have been giving payout to customers since January 2023, and they have been giving payouts to customers consistently and regularly. You can see over here in the last 90 days, they paid out over $63 million to customers all around the world. So if you want to sign up for this prop trading firm, I'll put the link in the pinned comment as well as the description. Nowadays, brokers don't literally call you and tell you, hey, we are closing your trades. Some brokers will actually send you an email telling you there's a margin call. Basically, it's when brokers liquidate your position without asking for your permission. They're just going to give you a warning. That's it. They're not going to ask you, hey, can we close your trades? No, they're just going to do it, okay? Normally happens when your account falls to 25% of the required margin, but also depends on your broker. So ensure that you check your broker's margin requirements and liquidation policies. And where do you find all of these policies requirements? It is when you sign up for a brokerage account. They would give you a long agreement where you need to read through before you agree and then sign up for the account. Make sure you read in between the lines. The requirements will depend on your account size and whether you're trading micro, mini, or standard lots. And some brokers' liquidation policies, they will allow all positions to be liquidated if you fall below the margin requirements. Whereas for some other brokers, they would do it differently. They will close the largest position that you have first, then followed by the second largest, third largest, fourth largest. Basically, they close a portion of your losing positions, and some just close all entirely. So you gotta read the fine print so that you don't get surprised when you get margin call. But hopefully you won't get this, because if you manage your risk properly, you don't need to be too concerned about getting a margin call. This is for those who don't even care about risk management, and this is the day where they'll wake up and then realize how important risk management is. Okay, personally, I've gotten a margin call in my first year of trading, so I learned it the hard way. So let's say if you have a $10,000 account, okay, one example, and you use a leverage of 1:2, means that a position size of 20,000 would require a $5,000 margin. Again, how do you calculate that? Just now the formula, margin is equal to position size divided by leverage. So if you weren't clear just now, oops. Then this is a very simple example. So this means that you would require a $5,000 margin. And if the margin call is triggered and your equity falls to 25%, which is about 1250, then you get margin call. Basic high school math, okay, times 25%, which gives you 1250. So when your account falls to 1250 or below, then you get a margin call. Okay, let's get into win rate. Basically, I'm sure you know what win rate is. It's the percentage of winning trades out of the total number of trades. And this is what a lot of beginner retail traders focus on. Unfortunately, this is what a lot of gurus who learn everything from Google teach on YouTube, social media too, because things like 95% win rate, 90% win rate gets a lot of clicks and sales, core sales. So basically, if you make 100 trades and 60 of them are profitable, your win rate is 60%. Most beginner retail traders fail because they only focus on win rate. I can tell this is not as important as how people proclaim it to be. And being too obsessed with winning all the time will actually cause you to lose more money. Because if all you want is to try to hit a high win rate, you're going to take profit first. Like when you buy today and the price goes a little bit before even reach your TP target in an attempt to get a high win rate to prevent the price from going down later on, hitting a stop loss. A lot of people will just take profit here. And you can have a 99% win rate and still lose money in the long term. Okay? Last time in my first year, I learned from this mentor. He taught me how to do 50 consecutive wins. And I achieved that within like 2 weeks. Okay? But then, right after that, that one losing trade, because that person really didn't taught me much about risk to reward. And the stop loss setting is very haphazard. It's like you can just set it as wide as possible. That one losing trade wiped out the previous 50 consecutive wins. So there's no point focusing on win rate so much. Even though having a high win rate helps to build your confidence, because a lot of times when your win rate is too low, you will have a losing streak. So there's pros and cons of everything, okay? The key thing is to find a sweet spot. Is it 50%, 60, 70, 80? Doesn't mean the higher the better, okay? Because higher win rate means you have a worse off risk to reward ratio as compared to somebody with 50% win rate would have a better risk to reward ratio. It's inversely proportional. So when you have a 50% win rate, okay, I want you to set your expectations right. The chances of you having 5 losses in a row is 100%. And your average losing streak will be around 6 before you get a 7th trade, which is a winning trade. 9 losses in a row, very small chance, but there's still a slight possibility, 10%. When you have a 60% win rate, you would get 4 losses in a row. Average losing streak will be 5. So as you can see, higher win rate, then your losing streaks will be shorter, right? Which is good because it helps build your confidence. But if you're somebody who is like very patient, you can understand that okay, losses are part of the process. Then you can afford to pick the lower win rate strategies and then have a higher, better risk to reward ratio. Okay. The key thing is make sure you pick a system, a combination that fits your trading personality and risk appetite. Okay. So let's get to risk to reward ratio. And a lot of hedge fund managers have very good risk to reward ratio. I can tell that the top hedge fund managers that I've spoken to, I've spoken in hedge fund events for the past 2 to 3 years. They invite me there to speak, and then sometimes I teach them things, okay? And at the same time, most importantly, I also sit back and learn from them. They normally have a win rate of 40 to 55% only, whereas the retail traders that I talk to, a lot of them try to aim for like 80 to 90% win rate. You see the difference? Now, risk reward ratio is the ratio between the potential profit and potential loss of a trade. I'm sure you already know this. Let's say this is your entry price, this is your TP, this is your stop loss. The ratio between these two is your risk to reward ratio. Commonly used yardstick is 1:3. Try to strive for a system that has 1:3, but this means that it's going to compromise on your win rate. If you're okay with that, then go with it. If you're okay with that, then go with it. Okay? I'm not telling you to. You must follow a 1:3 risk to reward ratio. You gotta pick a strategy that suits your personality. Okay? Basically, 1:3 means you're willing to risk $100 to make $300. You can have a losing streak, you still be confident because you know that okay, the big win is coming, and in the long term I will be profitable. So this is the mindset that I adopt every single day, because my risk to reward is normally 1:3, 1:4, sometimes 1:2. Based on your risk tolerance, bare minimum 1:1. Never have your stop loss being wider than your TP. Because if you take into account other things like spread, slippage, you're gonna earn so little. And you're making the broker rich. Let your profits run, cut your losses short. Easier said than done. Because for a lot of retail traders that I see, even though they understand this, but then because of trading psychology, let's say they buy here, price goes up a little bit, they are scared that the price will U-turn. So they take profit fast. And when the price is all the way down, they are going to wait until the price and hope that's going to retrace and go back up. So end up that losses become very big. If the price doesn't U-turn, then TP becomes very small. So their risk reward is like very bad, okay, because of trading psychology. If you watch my trading psychology talk on YouTube, the one that I published recently, you understand why, because it's human nature. So this is just a reference for you. You can see that this is the risk reward, whereas on top here is the win rate, okay? So let's say if you have a 50% win rate, you will need a 1:1 risk to reward ratio to be able to break even and a 60% win rate to be profitable. If you want a 1:3 risk to reward ratio, you can have a win rate of only 30% and you become profitable. And in that way, when you use this strategy, you wouldn't be too concerned about a losing streak because you know that your profits will eventually cover up your losses. 1:5, even better. You only need to win 20% of the time. But of course, ideally, you want it to be here. High win rate, good risk reward ratio. Again, pick a strategy that fits your trading personality. All I can tell is that the best traders in the world, the best futures traders even, their win rate is around 40%, 50% because their RR is very good. Okay, nowadays with trading softwares, you can just do everything with the help of tools, even the profit calculations. You can go to trading view and then click onto this tool over here. Then you can calculate your risk to reward using this tool. Long position, short position. Let's say you want to buy here. Okay. This support zone over here. Okay, you buy here, this level. And then your TP target, you set it right here based on a previous swing high resistance zone too. Stop, you put it below the support zone, and hence you have a risk to reward ratio of 3.59, which is very good. So you can use this tool in TradingView. Also, you can use it to backtest, calculate your profits, and then test out your trading strategy. Okay, stop loss, I'm sure you know this too. It's an order placed to automatically exit a trade when it reaches a predetermined loss. If you want to become a successful trader, disciplined trader, make sure you set your stop loss before you open a trade, okay? Limits downside risk, prevents emotional decision making. Also, so that you don't need to sit in front of the chart to monitor. And a lot of experienced traders, they use mental stop loss only if you are disciplined enough and you know that you can handle your emotions. Because if you cannot, then it's better to not use a mental stop. Set your TP, stop loss beforehand, then you don't need to sit there and monitor the charts. Because I can tell you that the more you sit there and monitor, the more you're going to do stupid things. Okay, some ways to set stop loss levels based on technical level, support resistance, like I showed you just now, based on your percentage risk per trade, dollar amount stop loss, based on ATR. Now, this is an indicator that you can use to measure the volatility at that point in time. Then you can set your stop loss based on the volatility. And this is a strategy used by turtle traders. This is a highly recommended book by a lot of traders because it's a story of how a group of people took in 23 novice investors and then turned them into overnight millionaires. And this one of their strategies using volatility to set their stop loss. But this is for another video since this risk management course. Let me know down in the comment section if you want me to do a video on this, okay? I'll put the book link down in the description too. Time-based stop loss. I know a lot of traders who actually has an open trade but doesn't want to hold their trade over the weekend. So Friday night before the market close, they're just going to close the trade. regardless of whether it's a profit or a loss. I just don't want to hold the trade over the weekend. So you can understand that placing a stop loss is a combination of both technical factors and also money management considerations. A lot of traders, they just set the stop loss based on the chart alone. From today onwards, also take into consideration on how it will affect your lot size. Okay. So you can manually adjust your stop loss, or you can use a trailing stop, which is sort of like an automatic stop loss that will move with the market price. So as the price moves up, the trailing stop, okay, will move up along with the price too. Okay, and then eventually you get stopped out when the price comes down and hit your trailing stop. And it's commonly used in trend following strategies, more of a long term strategy rather than for short term trading. And this allows you to lock in profits, ride the trend longer so that you can earn more profits. And when developing your trading strategy, always determine what price levels need to be surpassed to justify moving your stop loss. And this is for those who manually choose to move your stop. And be very careful with this because you don't want to move your stop because you're scared that the price will hit your stop loss. Okay, a lot of people, they buy here, initially they set their stop loss here, but when they see a price coming down going very near to their stop loss, they are going to widen it, and then price unfortunately goes down more, and then they are going to drag it downwards some more. This is what I don't want you to do. The only time you should really move your stop loss is to tighten it, okay, because of changing market circumstances. So back to the trailing stop. To set your trailing stop, you just need to set a percentage or dollar amount below the current price if you're opening a long position. So you can manually do it too. If the price goes up instead, you can move your stop upwards to tighten it, okay, so that when the price comes down, you still get a portion of the profits and not lose money entirely. So it is fine to move your stop loss upwards towards the entry point, but when it comes to TP target, please don't adjust it just because you're greedy, unless it is based on your trading strategy. But we normally wouldn't even touch the TP target, just leave it there because it's already based on your trading plan. The only thing we can move as the price moves is the stop loss. But target price is better if you don't move it, okay? So let's say today you decide to sell right here, okay? And you put your stop over here at the resistance. Once the price broke this support zone over here, you want to ride the downtrend, okay? This is when you can manually move your stop to just above the support zone or within the support zone. So this one example on how you can do it. Or you can just set a trailing stop once the price broke this support zone. Now I've already done a video comparing having a trailing stop with a fixed stop and calculate the profitability. The truth of the fact is that trailing stop is not a lot more profitable as compared to a fixed stop. Because as the price moves and your stop loss moves along with it, it can come back down and then stop you up before it continues. Whereas if you had a fixed stop, let's say over here, you never moved it, you can ride the trend longer. So there's a trade-off when it comes to trailing stop and fixed stop. Again, choose one that fits your trading personality. Okay, so when it comes to target price, let's get into it. Some people call it take profit. TP in short form. In order to close a position when the price reaches a set level of profit, set your TP before you buy or sell, please, because otherwise you will sit there and then monitor the charts and then do a lot of stupid things. Allows you to lock in gains without needing to monitor the trade constantly. A lot of times I just let the markets do its thing. Combine TP orders with stop loss to automate risk management. Take partial profits if you're riding the trend. So a lot of people, they would buy, and then once price reach a certain level, they are going to take half of the profit. And once price switch the next swing high, for example, they are going to take out their entire trade. So it's like a gradual profit taking. You can also use this strategy. Make sure you don't have a target profit that's too tight, because there are massive dangers when it comes to setting a small TP. Of course, common sense tells you that you wouldn't earn a lot of money if you have a small TP. But also, it's because of the spread. So let's say if your strategy tells you that, okay, you need 10 pips to become profitable. So you're using, as you can see over here, a 1:1 risk to reward. But because of the spread, this dynamic already changed. Because of the spread, you now need 12 pips of movement in order for you to profit, and only 8 pips against you in order for you to lose money. So the odds right now become 1:5 compared to 1. The key thing is we want the ratio to be as close as possible to 1:1. Let's say if you aim for 50 pips and your stop loss is 50 pips, 1:1 again. Okay. Now, because of the spread, you would need the price to move by 52 pips for you to become profitable, and for the price to move 48 pips for you to lose money. Now, if you calculate the odds, now it becomes better. So, do you see how important it is to have a large profit target? I know a lot of people like to take small targets because they want a high win rate. Okay, they set it really, really tight because it's so easy to make money like this. Price move a little bit, you can TP, right? But when you're doing this, you're kind of like working hard for money rather than having the markets work hard for you. Let it run to 50 pips, and then eventually your odds are better too. Of course, for hedge fund managers, because of their capital and restrictions, all that, they don't aim for like 10 pips, 20 pips. They aim for thousands of pips sometimes. So a lot of them are position traders, and hence their odds are a lot better than this. Okay. Okay, some of the ways to set target price based on your risk to reward ratio. Now, before you enter a trade, make sure that the risk to reward is very good. Okay. Based on FIBO, extension levels, SNR levels, psychological round numbers. It's because human nature is like that. Okay. We like round numbers. People like to set prices at 1.000, 2.5000, because it's like when you tell people to meet you for coffee. Okay, you don't go and be like, let's meet at 3:33 p.m. That's kind of weird. Human nature, we like to be like, oh, let's meet at 4:30, let's meet at 5. Same thing. Previous swing highs and lows, you can combine a couple of these together, like what I showed just now. I'll show you one example later too. Trailing take profit with ATR. Like I said, if you want ATR videos, let me know in the comment section below. So over here, you can see that we have the resistance zone over here. I'm drawing a line just to make things simple so that I can explain easily. Okay, which became resistance over here as well. But at the same time, it is also placed at a round number. Okay, 110.600, because traders would normally take profit there, or they would put their stop loss there. Again, over here at the bottom, you have a support zone. But I draw a line for simplicity's sake. At the same time, it is also a round number, 106,000. Okay, so you can combine these two together to increase the probability. But of course, don't set a stop loss at a place where everybody is going to place it at, because nowadays with market makers, they can see where you put your stop loss. Okay, so you need to learn how to spot institutional candles where market makers would take all these retail traders out before they move the price back up again. But again, because this is a risk management course, I'm not going to go into detail on that unless you want me to cover more on that. Okay. Should you adjust your TP? Just now I mentioned already, not recommended for beginners. If you do, ensure that it's because of special circumstances, which is not very common, and that doesn't break your trading plan. This should never happen too often. Ideally, never. It should only happen when there's a surprise interest rate change, for example, or policy shift. So this would come down to understanding fundamental analysis. Okay, and this is what I cover a lot in my channel. Or a major breakup from a major technical level. Like this is a not a swing high, but a price high that was dated way back in, let's say, 2008. Or when you are using a trailing stop loss. Like I said, ideally try not to touch your TP once you've set it. There may be only a dozen times in a year where you need to adjust your TP. Okay, again, put this into your trading plan. When should you adjust your TP? So that way it becomes part of your plan too. Alright, let's talk about drawdowns. It's the percentage decline in your trading account from its peak to its lowest point before recovering, usually a result of a losing streak. And this is very important. You gotta manage your drawdowns. Never exceed a drawdown of 30%. Okay. Larger drawdowns require larger gains to recover. Later I'll show you what I mean by this. So if you have a $10,000 account and then you lose money and then now you have 5,000. So you lost 50%. So how much ROI should you generate to make it back to 10,000? A lot of beginners might think, oh, 50% ROI? No, the answer is you got to generate 100%. And that's not easy. So that's why it is absolutely important that the number one priority that you should have is managing your drawdown. Ensure that you find out your strategy's maximum drawdown when backtesting. I've already done a backtesting video too. You can check it out after this course. Okay. Okay, that's a way to estimate future losing streaks, even though nobody can predict things, including me. So let's take one example. Let's say your win rate is 60%, and hence your losing rate will be 40%. What are your chances of getting 5 losses in a row? You can actually calculate this. This is called the theory of runs. You can play around with it, okay? Take your losing rate, okay, which is 100% minus your percentage win rate. 0.4 power 5. Or you can just do it manually. If you don't understand. 0.4, do it 5 times. Okay, if you pay attention in math class, then you get 1%. So you have a 1% chance of getting 5 losses in a row, which is very low. So this is why having a high win rate is good for you too. So it's not entirely bad. The more you lose, the harder it is to recover. So you can see that when your drawdown is only 10%, you only need 11.1% to recover. 50% loss, you require 100% ROI to recover, which is gonna take a long time. And a lot of people would engage in revenge trading over here. So the maximum should be 30%. Okay. Now this Paul Tudor Jones, I study him a lot because he's a very successful hedge fund manager. Trades Forex, he's a global macro trader, relies a lot on fundamental analysis when it comes to Forex. He says if you have a losing position that is making you uncomfortable, the solution is very simple, get out, because you can always get back in. And he's very strong on risk management. And you'll be surprised to know that his win rate is only between 40 to 55% because his risk to reward is very good. 1:4, 1:3. And another quote that I really like, I'm always thinking about losing money as opposed to making money. So basically, before he opens a position, he'll think about the downside first. Don't focus on making money. Don't focus on making money, which is what most retail traders focus on. Focus on protecting what you have, and the profit will take care of itself. And the problem with drawdowns, of course, it hurts your bank account. It also hurts your ego. So a lot of people would engage in revenge trading after a drawdown. So people are very angry, but some people they withdraw and then become super scared, okay, fearful. So they don't dare to open another trade. So it's kind of like it's not worth it to just take that temporary big risk. So in the next lesson, if you are subscribed only for my subscribers, okay, I will cover on professional risk management. Just now I mentioned about hedge fund managers. These are the events that I've spoken at. These are hedge fund CEO, and then these are prop trader, and then these are portfolio managers from various investment banks in Singapore like Goldman Sachs, JP Morgan. Because a lot of people, when they look at me, they don't do their research on me, and then they are like, who are you to talk about hedge funds, what they do? I have a finance background, I have a finance degree, I've been to various investment banks, invited to Goldman Sachs, JP Morgan, as well as GIC in Singapore, so I think I know what I'm talking about. I'll cover on risk adjusted returns, key metrics used by institutional traders to measure risk, diversification of your currency portfolio, how to diversify properly, some risk management tools, common risk management mistakes, how to outperform hedge funds. You don't need to have a crazy, perfect trading strategy, and you can outperform them, as well as risk management secrets. One very important before you go is that there are a lot of fake accounts pretending to be me on social media, Facebook, Instagram, and they'll go around messaging people. So if you see a careful account messaging you, chatting with you, that is not me. And I'm also not using WhatsApp, Telegram at all. All those there with my profile pic, with my name, those are all fake accounts. Stay tuned for this next lesson. Talk to you soon. Bye.